Welcome everyone, and thank you for joining us today. I'm excited to present to you the topic titled Understanding Market Dynamics. This presentation is brought to you by Software STC Market Bowl. Today, we'll explore the concepts of premium and discount zones and what they mean for market behavior. We'll look at how these zones influence trading decisions and help us better understand market movements. So, let's dive in and get started. Premium and discount zones are essential concepts that reflect institutional valuation. They help traders understand where the market perceives value to be, based on broader market dynamics. When we talk about premium zones, we're referring to levels where an asset might be considered overbought or overvalued, signaling potential selling opportunities. Conversely, discount zones indicate undervalued levels, which could present attractive buying opportunities. By recognizing these zones, traders can make more informed decisions about when to enter or exit positions. Overall, these zones serve as a guide, helping us align our trading strategies with the broader market sentiment and institutional behavior. This understanding is key to navigating the market more effectively and optimizing our trading outcomes. The 50% level is really a critical point to understand in trading. It helps us identify market zones, which are essential for making informed decisions. Think of this level as a kind of pivot point. It's where the market often shows a change in momentum. This makes it especially important for institutional entries, because large players tend to focus on these key levels to enter or exit trades. Understanding the 50% equilibrium concept means recognizing that the market often gravitates around this midpoint, balancing between bullish and bearish tendencies. When price approaches this level, it can act as a support or resistance zone, giving us clues about potential reversals or continuations. So, in the bigger picture, mastering this concept helps us see where the market is likely to turn or consolidate, and it ties directly into our overall goal of trading more strategically. It's about knowing where the market's energy is concentrated and using that insight to improve our trades. Let's talk about how to identify swing points and use Fibonacci retracement to clearly define zones for smarter trading decisions. First, spotting swing points, those key highs and lows, helps us understand the overall trend and potential reversal areas. Once we've marked those, we can apply Fibonacci retracement levels, which act like a map to pinpoint where price might find support or resistance. These levels allow us to accurately delineate premium zones, where buying might be more favorable, and discount zones, ideal for looking for entry opportunities. By doing this, we're not just guessing, we're using precise tools to make more informed and confident trading decisions. This approach ties back to our overall goal of trading with clarity and discipline, leveraging technical analysis to improve our results. Institutions focus heavily on optimal pricing and risk management. This approach allows them to enter markets with low risk while still maintaining favorable risk and reward ratios. The goal is to achieve consistent successes over time. When we understand their rationale, it becomes clear that managing risk effectively is key to sustained performance. They carefully evaluate each entry point, ensuring that the potential rewards justify the risks involved. This strategic mindset aligns with the overall theme of disciplined, informed decision-making in trading. By prioritizing these factors, institutions are able to navigate markets more reliably and achieve steady results. The premium zone indicates where institutions typically sell, capitalizing on overvalued market conditions to maximize profits. Understanding the premium zone means recognizing this as the institutional sell area, where large players often choose to exit their positions. This is usually when the market is overbought, and prices are at a high point relative to their intrinsic value. By selling within this zone, these institutions aim to lock in gains before a potential market correction. This concept is crucial because it helps us see how big players operate in the market, often influencing the overall trend. Recognizing these zones can give us an edge, allowing us to better time our own entries and exits. It ties into the broader theme of understanding market behavior and making more informed decisions based on institutional activity. The discount zone is a crucial area in our trading strategy because it serves as a key point for institutional buying. Essentially, this is where smart money tends to step in, taking advantage of the most favorable prices. By understanding the discount zone, we can identify optimal entry points, especially when the market is offering strategic opportunities for larger players. Recognizing this zone helps us time our trades better and align our actions with the overall flow of institutional interest. So, in the bigger picture, the discount zone is about spotting those high-value opportunities where the risk-reward ratio is most favorable for strategic entries. Now, let's talk about how analyzing break of structure, or BOS, and change of character, CHoCH, can really improve our entry precision and help us fine-tune our trading strategies. When we spot a BOS, it indicates a shift in the market trend, signaling that the previous structure might be invalidated. CHoCH, on the other hand, shows us a change in the market's behavior or momentum, which is crucial for timing our entries. By combining these insights with our understanding of premium and discount zones, we can better identify high-probability entry points. Premium zones are areas where the market is relatively overbought, while discount zones are where it's oversold. Recognizing these zones within the context of market structure allows us to align our entries with the overall trend and market condition. This integration helps us not only to refine our timing, but also to optimize our risk-reward ratio. Essentially, it empowers us to make more informed decisions, ensuring that we're entering trades at the most advantageous moments based on the market's structural behavior and zone context. So, mastering this analysis is key to elevating our trading game, making us more precise and strategic in our approach. Liquidity sweeps are a crucial factor in defining the overall market direction. When you see these large liquidity movements happening, they often indicate where the market is heading next. Think of them as the signals that show the larger trend in play. On the other hand, zones are the areas where institutional traders tend to place their entries. These zones highlight the most optimal points for executing high-probability trades. Understanding where these zones are can give you a significant edge in timing your entries more precisely. Connecting these ideas back to our overall theme, recognizing liquidity sweeps helps us understand the broader market trend, while zones guide us to the best locations to enter trades within that trend. By combining these insights, we can develop a more strategic approach to trading that increases our chances of success. All right, let's go over these crucial steps to ensure we're aligning with smart money behavior. First, we need to confirm the liquidity taken. This means checking if there are enough orders or stops above or below the current price, indicating potential areas where liquidity is concentrated. Next, we look for bias. Are we in a bullish or bearish trend? Understanding the overall market direction helps us make smarter decisions. Then, we verify that the price is in the zone, meaning it's at a key support or resistance level, or within an area of interest where institutional players might be active. Finally, our entry should ideally come from a fair value gap or an order block. These are areas where institutions have previously shown interest, so entries from these zones tend to have a higher probability of success. Following these steps carefully helps us align with the smart money and increases our chances of executing a winning trade. Let's take a closer look at the bullish setup. Here, we've identified key entry points within the discount zone, which suggests potential opportunities for bullish trades. These zones are critical because they often represent areas where the price has pulled back enough to offer a favorable risk-to-reward ratio. Moving on to the bullish scenario on XAUUSD, this scenario outlines how the market could develop if the bullish conditions play out. It's important to keep in mind that these setups are based on technical analysis and market behavior, but they also need to be confirmed with proper risk management. Overall, this slide ties into our broader theme of identifying strategic entry points and understanding market psychology to capitalize on potential upward movements in gold. All right, as we wrap up, I want to emphasize the importance of focusing on institutional strategies and understanding the market realities that drive our decisions. It's essential to look beyond surface indicators and really hone in on trade value itself. When we talk about trade value, we're considering the overall worth and impact of trade activities, rather than just relying on isolated indicators or short-term metrics. This approach helps us make more informed, strategic choices that align with the bigger picture. Remember, understanding the true value of trade and tailoring our strategies accordingly is key to staying competitive and resilient in a dynamic market environment.